Welcome back for day number 4 of the beginner bootcamp. Today, we are going to be going over my favorite video so far, and that is going to be market concepts, which is the fundamentals and what we use to actually trade and get entries and see the market way clearer. So, what we are going to be getting into today are the market concepts. Today, we are going to cover fair value gaps, inverse fair value gaps, SMTs, open high low close, and open low high close, CISDs, and every single one of these plays is a key role in helping you spot entries with higher conviction, time your trades with better precision, avoid getting trapped by fake moves, and understanding why the market's moving, not just that it's moving, which also ties into our last lesson of liquidity. If you haven't watched that yet, I highly recommend that you watch that before watching this. So these aren't just concepts. This is the foundation for how smart money enters and delivers price. So the first thing we're going to be getting into is fair value gaps. The one of the easiest to understand ever. Um, Basically just a three candlestick pattern. It's where there's an imbalance in price. This happens when candle 1 and candle three's wicks don't overlap. This imbalance signals that price moved too fast, and institutions will often return to that zone to fill orders. So this is exactly what you look for on this illustration that I drew perfectly. Candle two's body is the actual imbalance. Consequent enroachment is 50% line of the fair value gap. I didn't draw it on there, but where you will usually see price bounce off of is not going to be the top, or obviously in a flip scenario, the bottom. You will see it bounce off of the middle of price. You can basically see, like, you can almost see a fair value gap as a support level. And if it rejects that level, you usually see price trade in the opposite direction. So wait for all candle wait for all three candles to close. No fair value gap exists until that third one is confirmed. Most fair value gaps become great entries or reaction points, and you can use them for entries, continuation zones, or confirmation. Keep in mind, wicks from candle 1 and 3 do not touch equals a fair value gap. Candle 2 creates the imbalance, and 50% CE level is often respected. If it is disrespected, you can often see price continuing in that direction, which we will get into when we talk about inversion fair value gaps. So you can see here, same 1, 2, 3 candlestick pattern. Candlesticks 1 wick and candlestick 3 low wick do not touch, creating a fair value gap right here. We then close below it. Keyword, close below it, not just trade below it. We close this candle below the fair value gap, basically disrespecting the gap entirely. We open up this candle, we can usually see price continuing in this downwards direction. An inverse fair value gap is created when a fair value gap gets disrespected. Price doesn't reject it or bounce off of it like it normally would, and instead price closes through the fair value gap. When this happens, the fair value gap isn't valid anymore, and that's the same zone that can now become an entry area in the opposite direction, uses support or resistance depending on the context. So how to spot an IFVG is price trades into a valid fair value gap. Instead of rejecting it or respecting it and continuing higher in this scenario, it then rejects it. This invalidates it as a support zone or rejection zone. You can now see you now want to see a full candle close outside of the gap. That fair value gap now becomes a flip zone, a place where you could look for an entry in the opposite direction. And this is super important. Always wait for the candle that breaks the fair value gap to close. You don't want to enter too early. You have to let price show you that it is indeed disrespecting that fair value gap. This IFVG right here forms when the candle closes fully through the original fair value gap. Price no longer respects the gap, so it flips into a resistance zone. Always wait for the candle to close outside of the gap before confirming your inversion. So SMTs, super important. I see a lot of people struggling with this, so I tried to make the best possible illustration that I could. An SMT is just correlated assets between NQ and ES usually move together, but if one makes a higher high or sweeps certain liquidity that the other one doesn't, that creates a divergence in price, or an SMT. NQ makes a higher high, ES makes a lower high. That's a bearish SMT. This tells you that NQ is likely a trap and the move is about to reverse and doesn't need to continue back up higher. So this tells you that price is likely going to continue lower. In this scenario, a bearish SMT divergence occurs when two correlated assets such as NQ and ES exhibit conflicting price action. In this example, NQ forms the higher high while ES forms the lower high, failing to follow NQ's upward movement and sweep that liquidity. This divergence signals potential weakness in the pair that forms the higher high and often signals a market reversal. This is powerful because you're spotting what the algos are doing. Correlation is breaking down, which usually happens before reversals, and NQ makes the higher high, ES makes the lower high, bearish SMT. Simple as that. If you literally just look at this illustration, screenshot it, whatever you need to do, but this is all you need to know what a SMT is. It is not that complicated. It's just when one pair sweeps a high or a low that the other pair does not, signaling weakness in the opposite direction of the sweep. So, open, high, low, close. We already covered this in the first episode, but we're going to just quickly go back over it again. Open, high, low, close is when, the candle open. It's just the anatomy of every single candle. Candlestick structure tells the story of each price bar. Open is where the candle starts, high is where the point reached, low is the lowest point, close is where it ends, and then the opposite in a opposite scenario. You got to use this to understand which side of the candle was aggressive, identifying displacement candles, recognizing absorption and indecision. Think of an open high low close or an open low high close as a roller coaster. It shows the full emotional ride of the entire candle. It is the anatomy of the candle. Open high low close and open low high close candles let you read the flow of price. Open highs, lows, and close all show you what buyers and sellers are doing during that one candlestick's time frame. So, change in state of delivery, also a great entry confluence. Make myself smaller right here. We'll go up in the corner. A change in state of delivery, or a CISD, is how the market changes its mode of delivery. It's very, very similar to a market structure shift, but basically just price bouncing off of the market structure shift and then continuing in that direction. You can use that as an entry. So the full sequence is consolidation or sideways chop, inducement or fake up or down move, and liquidity sweep. Then we get a shift in structure that usually breaks, or a break of structure or market structure shift. Then we usually get displacement or tap into. Strong move confirms the change, and you're looking for a level like a high time frame P array to get swept. That sweep plus displacement is your CISD. A bullish CISD is just sweep of swing low, displace higher, retrace, and then bounce off the break level. A bearish CISD is sweep swing high, displace lower, retrace, reject off the break level. A CISD is confirmed by liquidity sweep and displacement. This level gets retested or tapped back into, and price continues the delivery in the new direction. It is as simple as that, right? If you just look at the illustration that I drew, explains it perfectly. So that is literally all. That is all you need. So wrap up on market concepts, day number 4, the best video that you will see covering everything, because you need to know all this stuff. So this is exactly what you locked in from today. You know how to spot and mark fair value gaps and use them as entries or targets. You know how an IFVG forms, what confirms it, and how to use it for reversals. You recognize SMT divergence between NQ and ES and how to call the tops or the bottoms of the move. You understand candlestick structure with open high low close and open low high close for context, and you've seen how a proper CISD forms, which is what confirms it. If this felt like a lot, I will tell you right now, repetition whenever it comes to concepts is absolutely key. So watch this video as many times as you need. Go rewatch this, run it through your charts, get familiar with how these concepts actually show up live. And everything is moving forward is just going to build on this. This is the part where you start trading with precision. and actually knowing what you're trading instead of just going around guessing where the market's going to go and not having like it's basically like saving you from entering random points on the market. Now you know where you need to enter, paired with the liquidity that we learned in the previous episodes. So I hope you enjoyed this video. Thank you for showing up for day 4. If you haven't watched day 1, 2, and 3, I recommend you go do that. Like, subscribe, and stick around for day 5. Peace out, y'all.